Welcome to the Hurst Trading Room. My name is David Hickson and this is a video update for the 30th of March 2015. As always, please make sure that you have read and understood these disclaimers before we take a look at the markets. If you are watching this video anywhere other than on our podcast channel, then make sure that you subscribe to the podcast channel on either iTunes or YouTube, and in that way you will be alerted whenever I produce a new video. Now, I'm going to try to make this a very brief update. There isn't a tremendous amount to say about the markets. Those might be famous last words, but let's take a quick look. First of all, here is the S&P 500, which I like to analyze. Out of all the American markets, out of all the US stock markets, I find the S&P 500 in many ways the easiest to analyze. Is probably a personal preference, but certainly it gives one a very good idea of what's happening in the US stock markets generally. And as you can see, this particular analysis shows the 20-week cycle trough happening here round about the middle of the second week of March. And as I discussed in last week's video, there is the possibility that the 20-week cycle trough could have occurred over here at the beginning of February, or perhaps over here in the second week of March. And my preferred analysis at the moment is for the later 20-week cycle trough, in other words, the analysis you're seeing now on the screen. But both analyses are very possible, and so we have to watch the markets fairly carefully and make sure that we are making the right decisions, the right trading decisions, and being a little cautious about them, because both of these possibilities are very valid. Now, if this analysis is the correct one, as I believe it probably is, but one has to be careful of definitely putting our hopes on this particular analysis when the other one is also very valid. If this is the correct analysis, then of course, as I mentioned last week, this was the A category interaction between price and the FLD over here, which happened on the 18th of March, and that provided us with a good long trade, although in fact the price move did not quite reach the target for the A category trade. We could count the grid lines and work it out exactly, but it didn't quite reach that target. And so that is a slightly worrying aspect about this analysis. However, as you know, if you've been watching these videos, I am expecting a big peak to form in the markets, and I have been noticing and making videos about and writing blog posts about the fact that there have been some bearish cracks appearing in the markets. The markets haven't turned bearish, of course, yet, I don't think, but we are seeing some bearish cracks happening. And so when the market turned down last week and headed down at a very fast rate, right down to this 20-day FLD over here, the big question, of course, was, is that a B category interaction, or is it an F category interaction? And we'll look at the other analysis in a moment, which tells us to expect an F category interaction. As you know from last week's video, I was going to watch the move down to the FLD and then consider my options in terms of entering into a short trade. It moved down very sharply, but it did something that often happens. It stopped at the level of the FLD. As you can see, well, I shouldn't say it stopped at the level of the FLD, but it closed for that day. What is that, the 25th of March? It closed for that day right at the level of the FLD. Can you see that? That's where it closed. The low of the day was just a little bit lower, just a bit below that. And if you were expecting an F category interaction, which was certainly one of the possibilities, then that might have been a level at which to enter into a short trade. At that point last week, I was still undecided about it, and it was still looking very much like a B category interaction to me, and perhaps I should elucidate some of the reasons for that. And so I didn't get into an F category trade. There were two primary reasons why it didn't look very much like an F category interaction. The first one was this. It had to do with the cycle shapes. As you know, I always look at and speak at length about the cycle shapes that form in the markets. But here was the cycle shape for this 20-day cycle. Now we had a peak over there on the Monday, and it had come down to that point, and we were sitting at the FLD. At that point, this cycle was still looking like a bullish cycle. Yes, we'd had a very strong move down on this day. I think that was Wednesday of last week. We had a very strong move down on that one day, but it was still a bullish shaped cycle. And if this was an F category interaction, we would have expected to start seeing the cycles turning a little more bearish. So it wasn't looking quite right to me, and I thought the odds were still too high that this analysis was correct and that we had the 20-week cycle forming on the 12th of March. And so my confidence in the possibility that this was a B category interaction increased. But now, what about the fact that the next day, the Thursday, the market did drop down? I must say, as it dropped down below the 2040 level, I was thinking, oh, I've made a mistake, I've missed an opportunity. It's important for me that that I don't make losing trades, of course. It's also important for me that I don't miss opportunities, but I would rather miss an opportunity than make a losing trade. And so I believe the markets are no place to have regrets, particularly for trades that you could have made but didn't. Yes, last week on Thursday I was thinking, oh, I missed that opportunity. But certainly today it looks as if though it was a false opportunity. Although, of course, this might still turn out to be an F category interaction. But let me just quickly show you another reason why I thought this might very likely still be a B category interaction, despite the strong move down into the FLD. You must remember that the interaction between price and the FLD is a constantly repeating sequence. It's a pattern. It's an expectation, but it happens every time in a slightly different way, and that's what keeps the markets interesting. If it happened in exactly the same way every time, there wouldn't be any fun in it, would there? So. One of the things that I looked at last week when I was considering this trade was the previous B category interaction, which you can see over here. Here was the previous 80-day cycle trough, which occurred on the 16th of December 2014. Here was the A category interaction, a good A category interaction, but you notice also a disappointing A category interaction. It was in fact something I wrote about a good deal towards the end of last year and the beginning of this year. That disappointing A category interaction was one of the bearish signs that I was noticing in the market. But do you see what happened with the B category interaction? Wow, the markets just dropped straight down below that FLD and finally settled for the 20-day cycle trough right down over here. That would have turned out to be a very good short trade. And so last week when I saw a similar thing happening, well, not really similar, but I saw a strong move happening down through the FLD, I was reminded of the previous B category interaction, which had turned out to be a good strong move down, but was still, nevertheless, in my opinion, a B category interaction. And generally B category interactions can be a bit messy and one ends up losing money on them. That's been my experience. That's why I never trade a B category interaction. Well, not never. I very seldom trade a B category interaction. I do trade a B category interaction when there's evidence that the previous 80-day cycle trough is most probably a straddled trough, but let's not go into too much detail about that here. But certainly as the markets begin to turn more bearish, which of course I'm expecting them to do, because I think the markets are in the process of forming, or possibly even have just recently formed or are about to form, a very major peak. And these bearish cracks are appearing. We're seeing them happen time and time again. And so In my opinion, what happened last week was still a B category interaction. I might be proven wrong. It might turn out to be an F category interaction, but it's still looking to me very much like a B category interaction. It just happens to be a B category interaction that is a fairly bearish B category interaction, because the markets are beginning to turn just a little bit ugly. Not ugly, they're beginning to turn a little bit bearish. And you can see the pattern happening again and again ever since the 18-month or perhaps 40-week cycle trough in the middle of October. We had a strong move up which ran out of steam, and then a sharp break downwards. Another strong move up which ran out of steam, and another sharp break downwards, which was of course the previous B category interaction. Then the markets fiddled around and really got very confusing for a while, and then at the beginning of February we had another strong break up which ran out of steam with a sharp break down. And out of the trough in the middle of March, potentially the 20-week cycle trough, we had again a fairly good strong move up, although not as strong as the previous moves, and then a sharp break down again. So we're seeing the same pattern happen time and time again. The markets are bouncing out of that trough with a great degree of volatility. They're running out of steam, and then they're breaking sharply, and they're falling quickly. And that is, in my opinion, a sign that the markets are turning bearish. So I really think we need to fasten our seatbelts and look out for this peak forming, and the profits are most likely going to be made to the short side. But of course, if this was the 20-week cycle trough that formed in the middle of March, then we do still have some good bullish moves ahead of us. And this is possibly a C category interaction that we're looking at happening next, and we should see a good move out of that, and there should be some profits to be made out of that. But is it impossible that that was an F category interaction that we saw last week? It certainly is not impossible. It is possible. Here is the alternate analysis. Let's just go through it quickly. You should be familiar with this by now if you see my previous videos. There's the 20-week cycle trough in the beginning of February, and of course the 40-day cycle trough that formed then in the middle of March, and that looks like a good bullish 40-day cycle, which is why this analysis looks quite good. It works quite well. This was the E category interaction then, and then last week's cross down was indeed the F category interaction. If this turns out to be the true analysis, what's going to be very telling is what happens here. What happens now. If price comes up to this FLD and seems to find some resistance, then that would be the G category interaction, followed by the H category interaction, and that should be a good profitable short trade as the markets carry us down into the 80-day cycle trough, which is expected, as you can see, sometime around about the middle of April. So what do we do now? Well, if you got into your short F category trade last week because you were convinced that this is the correct analysis, then you are probably, if you entered at the level of the FLD, you are probably in a slightly losing position, perhaps roughly a break-even position. That's not a disaster. Don't panic just yet. I don't believe. Don't get out yet. It is possible that is an F category interaction. You must follow your rules once you get into a trade. Your stop loss is up here. That's your initial stop loss, and so you would have calculated your position size to accommodate for a rise all the way back up there. Price may well come up to the FLD and then find resistance and then move down again. So if you're in a short F category trade and you calculated everything correctly, then you are willing to take a risk all the way up to that initial stop loss, and so you should continue to follow the rules. Of course, one of the rules is that as price comes back up to this FLD, you should exit if it crosses that FLD. And so you should take a smaller loss. If the markets turn bullish at the moment, you should take a smaller loss than you originally were willing to accept. So it's going to be very interesting to watch this FLD, whether you're in a trade or not. Watch what happens as price comes back to that FLD, which it will almost certainly do this week. you know, it's already heading back up to that FLD, as you can see, and sometime this week it's going to encounter that FLD. When it gets to the FLD, I will be watching it very carefully to see what it's going to do. If it is going to cross that FLD and move up sharply, then of course that would favor the other analysis with the 20-week cycle trough in the middle of March, and that would be the C category long trade, which should be a profitable long trade to enter into. If, however, price gets to the FLD, hesitates, finds resistance at the FLD, and then moves downwards, then that would be an indication that this analysis is more likely the correct one, and we would be in for a good short ride down to the 80-day cycle trough expected in the middle of April. That would be an H category short trade. Of course, if you are already in your F category short trade, then you would hold on for that. That's assuming the price does find resistance at the FLD. So this is really a vital and critical week in terms of telling us what is happening in this analysis. We need to see what price is going to do when it reaches that 20-day FLD. Let's take a quick look at the euro, and I've been speaking about the euro pretty much every week recently. And that's because it is possible that the very long cycle trough that I have been expecting and speaking about for some time, it is possible that that trough formed in the middle of March. That's the 13th of March. But as I've mentioned many times before, I don't jump at the trade, at the long trade yet. The bounce out of that trough has not been very bullish. We do have a slightly bullish 20-day cycle that looks as if though it has formed here with a peak over here. I think that is a slightly higher peak, is it, than the earlier one? That was Thursday of last week. And of course, price is coming back down to the FLD. Again, we need to watch that 20-day FLD and see how price interacts with it. If this is a trough of at least 80-day magnitude and potentially even a much longer cycle trough, then this was our A category interaction here as price broke up above the FLD in rather a messy fashion, I should point out, but that doesn't invalidate it. We would expect price to come back down to the FLD around about the formation of the 20-day cycle trough. Now the 20-day cycle trough is expected sometime this week, perhaps towards the end of this week, and so we would expect to see price finding support at the level of the FLD. If price does find support at the level of the 20-day FLD and then bounces back up again, we would have witnessed then the formation of the B category interaction and then the C category interaction, which should carry the euro to a higher price. However, at the moment, that is all speculation. It is also possible that the euro is going to turn down again and to continue moving down. I do still believe that the very long-term cycle trough lies ahead of us. There is the possibility that the long-term cycle trough lies behind us, but as I mentioned in last week's video, it just doesn't look very good to me. I tend to be a visual analyst. I like to see the shapes of the cycles on the chart, and it doesn't look very good to me. It is certainly possible, but it is my least preferred possibility. So I will also be watching the euro very carefully this week and seeing how the euro interacts with that 20-day FLD. Finally, let's take a quick look at gold. I spoke about gold in last week's video, and let's display, of course, there are two analyses that I follow in gold, and I spoke about it last week. The one is what I call an inverted analysis, and it assumes that the peaks of gold are synchronized as opposed to the troughs. I won't go into detail about that here, but according to this analysis, this was our A category interaction as price broke down below the 20-day FLD as it dropped away from the 40-week cycle trough that formed, in my opinion, in about the middle of January of this year. That was a 40-week cycle peak. Did I say trough? I have to be very careful when I speak about inverted analyses to remember to use the word peak as opposed to trough. That was a 40-week cycle peak in the middle of January. And then the 20-day cycle peak was very difficult to find in this strong move down. Gold has been moving with very simple, clean moves, which has made a short-term cycle analysis fairly tricky. The 40-day cycle peak almost certainly occurred over here at the beginning of March. Price popped up above the FLD for a brief day and then dropped down again. So in terms of our interactions, our B category interaction with the FLD was not a cross, it was a reaching interaction. You should know what a reaching interaction is by now. And then the C category interaction, as price dropped back away from the FLD, there was the D category interaction, a miserable and very disappointing D category interaction, reminding us how much bearish pressure there still is on gold. And here was the E category interaction as price dropped back down below the FLD the next day. And this, of course, was the F category interaction. Now, F category interactions are usually, in a normal analysis, very good short trading opportunities. In an inverted analysis, they are normally very good long trading opportunities. And indeed, this turned out to be a very good long trading opportunity. As you can see, our target was, I believe, reached. Yes, it was reached sometime last week over here. That was the target for that move, for that price cross of the FLD. Once price reaches the target, of course, it means that the cycle move that the FLD assists us with or informs us about, the cycle move is complete. It doesn't mean that necessarily the price move is over. Price might keep moving in that direction, but the cycle move that we're trading is over. So that cycle move was over last week on Thursday. Now, of course, price is coming back down to the FLD. We would expect it to come down to the FLD, find resistance, and then bounce back up again. That would be the G category interaction, and then the H category interaction as price comes up to the 80-day cycle peak. So I'm expecting price to come down to the FLD. I expect it to find support at the level of the FLD and then bounce up to the 80-day cycle peak, which is expected around about the middle of April perhaps. But we do need to be careful, because gold definitely still has a lot of bearish pressure on it, and so we need to watch the way in which it interacts with that FLD, and not jump at the long trade, the H category long trade, too quickly. Let's take a very quick look at the other analysis that I also track in gold, which is of course the standard, the conventional analysis, which has synchronized troughs. And here you can see the 20-week cycle trough that I spoke about last week, which formed, in my opinion, in about the middle of March. There was the A category interaction, a long interaction and a long trade, which looks like a very typical A category interaction. Do you see how it not only reached its target, but it exceeded it to the upside? That's very typical of an A category interaction. Price has come right back down again to the FLD. As you can see, it's just touching it today. Now, that is what we expect for the B category interaction. So I am not expecting gold to drop sharply down again at the moment. I'm expecting it to find support at the FLD. Of course, I might be surprised, but I'm expecting it to find support, and after it's been supported by the FLD, I would be looking at another break up to the long side. It's also not impossible, let me count the number of bars. It's not impossible that at 13 bars, that's a very early D category interaction, but it is very unlikely in my opinion. Gold usually has long cycles as opposed to short cycles, and so it is very unlikely to be an early D category interaction. I certainly expect to see some support found at the level of the FLD with a bit of a bounce higher again. Thank you very much for joining me in the Hurst trading room this week. I look forward to seeing you next time and wish you profitable trading.